Well, good morning and welcome to this SW Superannuation Changes webinar, wherever you may be joining us from today. My name is Sharon Burke. I'm a BPCA Director with SW and I will be moderating today's session, and I'll also be joining the discussion on the superannuation changes. My colleague Janelle McPhee will be presenting with me today. It's great to have so many of you on the line. As you know, it's Reconciliation Week, so I'd firstly like to acknowledge the traditional custodians of Australia and their connection to land, sea and community, and pay their respects to the elders past, present and emerging. Before we start, I'd like to run through some housekeeping. We recommend that you click on the Enter Full Screen button at the top right-hand corner of your screen to achieve the best webinar experience. Also, if you click on the Q&A button at the bottom of your screen, a pop-up will allow you to send questions as we go. We'll try and answer those questions if time allows. Otherwise, we might need to connect with you after the session. We will be circulating the slideshow after the webinar. And also, before we kick off, we're going to be running a live poll today. That poll question will appear on your screen now. It can be accessed at any time during the webinar, and as soon as you answer the question, it will disappear. Okay, now we're ready to start our presentation, so I'll hand over to my colleague, Janelle.
Thanks, Sharon. To start with, I'd like to run through a couple of key superannuation terms that I will be referring to during the presentation. Superannuation, or super, is the compulsory system of placing a minimum percentage of your income into a fund to support your financial needs in retirement. The Superannuation Guarantee, or SGC, is the minimum super you must pay for each eligible employee. SG is currently sitting at 10% of ordinary times earnings. If you don't pay this by the quarterly due date, the employers must pay the Superannuation Guarantee charge, or SGC. The SG due dates are as follows: 28th of October, 28th of January, 28th of April, and the 28th of July. What are the penalties for underpayment of SG? Well, employers will be liable for an SGC amount. This amount will include a shortfall amount, a nominal interest amount, and an administration charge. The ATO will also assess a penalty amount of up to 200% of the SGC. What actions should you take to minimise penalties? Well, employers should undertake a review and lodge SGC statements to avoid the possibility of excess penalties. It's not a matter of burying your head in the sand and hoping it actually goes away. The SGC payment. Directors must pay the SGC in full by the due date. If it's not paid, they may be liable for a penalty equal to the unpaid amount. A director's penalty notice can also be issued. Even without issuing this notice, the ATO can collect by other means. For example, they may withhold a tax refund. The ATO can work with you to find a suitable arrangement for your business needs. Paying super for your employees is not a tax or a form of government revenue, but rather an entitlement to serve your employees in retirement. Currently, employers are not required to make superannuation contributions for employees who are paid less than $450 in any calendar month. For individuals working casually or part-time across multiple jobs, they currently may not receive any superannuation contributions at all from employment. What's changing? From 1st of July 2022, there's several changes designed to make it easier for people to grow their retirement savings and create many opportunities for those who are younger, older and low income earners. The $450 Superannuation Guarantee, or SG, threshold will be removed. Who's excluded from this change? Well, those unfortunately under 18 years of age who work less than 30 hours per week, unless they are covered by a workplace agreement that will state otherwise. I'd like to now take you through an example of a person under the age of 18 and what the changes mean. Kate is 17 years of age. She works a 32-hour week once a month at a local bakery. She earns less than $380 before tax. Kate also works 6 hours a month as a barista at her local cafe. What are her employer's obligations? Well, Kate's bakery employer will need to pay her super from 1st of July 2022 because Kate has worked more than a 30-hour week once a week. Kate's barista employer will not be obligated to pay her super as she's only done 6 hours in the month. What should employers do to prepare prior to 30th of June 2022? Well, most of your payroll procedures and systems are currently configured to exclude super payments for those who earn less than $450 in the month. As an employer, I would be ensuring most of my processes and reporting is capable of meeting the new SG obligations from the first payment cycle after 1 July 2022. I'd be working with my payroll software provider to update my systems to ensure that you do not inadvertently underpay employees' superannuation entitlements. I'd also be ensuring that my employees' fund of choice is documented and recorded in the system. Those who are casually employed and earning less than $450 currently per month may not have their super details recorded in your payroll system. I'd also be reviewing my onboarding procedures and forms to capture new employees' stapled super fund account details. In particular, casual employees may have numerous small superannuation funds. You may recall that a stapled super fund is your super fund which follows you throughout your employment journey. You need to also ensure that with new employees that you are able to request super stapled details from the ATO when required. You should also ensure that your ABR website is updated so you can access these details, or you can engage your tax agent and confirm these for you. From 1st of July 2022, the SJG rate will rise to 10.5%. It's legislated to increase to a rate of 12% from 1 July 2025. Minimum SG contributions of 10.5% from 1st of July 2022 will also be capped to the MCB. The MCB will increase to $60,220 for the FY 2023 year. Currently, it's sitting at $58,920 per quarter for the FY 2022 year. Maximum superannuation contributions for an employee earning $240,880 or more is capped at $25,292.40. You may recall the MCB is what is legally required to be paid by an employer for superannuation. An employer does not need to pay more superannuation contributions, although there's no rules against doing so. We just need to be careful about your concessional cap. The concessional cap will also remain at $27,500 for the FY 2023 year. Your concessional cap includes your employer contributions, including salary sacrifice amounts, and personal contributions where you'll be claiming a tax deduction. If you have more than one fund, you will need to add up all your concessional contributions across all your funds. At the end of the year, the ATO will inform you if you exceeded this cap and what options there are to pay the extra tax. Employees who have multiple employers can choose to opt out of mandatory SG contributions. There are some rules around this, and it's not available to everyone. For example, if you are working under an award or an agreement, there is not the option to do this. I would now like to hand over to Sharon, who will walk us through what an employer should do prior to 30th of June 2022 in relation to employee contracts and total remuneration packages. Thank you.
Thanks, Janelle. Now, before I start, we have another poll question, which should be popping up on your screens now. Once you've answered the question, the pop-up will disappear. Okay, so there's 35 days until the end of the year. So what should you be doing now to plan for these superannuation changes that Janelle's spelled out for us? So the first thing I would recommend is that you get out all your employee contracts, review them, and work out which employees are on a total remuneration package, is what we call a TRP, and those employees who are on a gross salary plus super plus benefits package. So you've got your two packages, put them into your two buckets, and then work out how the changes will affect those employees. So those employees who are on what we call a TRP, they are going to have an impact to their cash salary. So what's going to happen is that their overall rem will not change, their cash salary will go down, and their superannuation will go up by the equivalent amount. So everybody knows that nobody likes a pay cut. And so whilst the employees know that they're getting a benefit, additional benefit to their superannuation, they may not like the immediate tax cut to their cash salary. Where the business can support a wage increase, we think now is a really good time to do your salary reviews, and where the business has the ability to be able to support that pay rise, put your pay rises through on the 1st of July so nobody has a hit to their cash salary. If you're going to do that, obviously it's important to understand how this is going to affect the business's overall profitability. And so we recommend you do a budget and a cash flow forecast to make sure that you can support the changes that you're going to make. For those employees who are on the gross super, base salary plus super, they won't have a change to their gross salary. They will have a change to their superannuation. So they'll see a real benefit flowing through for their superannuation. The issue for the employer is that they're going to have to fund that additional superannuation payment, and also they have to fund the additional cost for payroll tax where they're registered and for work cover. So to work out how this might affect you, let's run through some examples. So I've got, next slide please, thank you. So I've got 4 examples that I'll take you through. So in the first 2 examples, I'm going to look at a high income earner and what the changes will look like if it's a TRP or if it's a gross salary plus super. Example 3 and 4 take you through a medium income earner with the same scenario. So if we have a look at example 1, we've got an employee on a base salary of $300,000 because they're a high earner, they're subject to the maximum contribution base. At the moment, that's sitting at $23,568 per annum. That's going to increase to $25,292 on 1 July. So that means a real increase in superannuation contributions for that employee of $1,724. That has to be funded by the employer, and then the employer has to add on the payroll tax and work cover. I've estimated that at, say, 5.85%. So the real cost to the employer is $1,824, and that's per employee. So if you've got a large executive pool earning a lot of money, it's actually a real material cost to that employer. Okay, let's look at the situation, next slide, under a TRP. So under the TRP, nothing changes for the employer. The employee is still on an inclusive remuneration package of $300,000. What will happen is their super will go up to that 25292, their base salary will go down by $1,724. So this was the communication piece that I was talking about. Really good to tell your employees you're going to lose a little bit of cash. What does that mean on a monthly pay? It's about $143. After tax, they're probably sitting around $75, $80 loss. So not a lot of money, but you need to be aware, otherwise you'll get a lot of please explain questions from your employees. Now, let's look at a medium income earner, say on a salary plus super, earning $120,000. The super is currently $12,000. That's going to kick up to $12,600. So we've got an increase in their super of $600. Add on your on costs, the real employer cost is $635. If you're a large employer, you can see how this will multiply. So you need to be able to fund these increments and have your systems in place to be able to deal with it. The last example is a TRM. So again, we have a package of 132. So all that happens is your superannuation increases, but it's a different amount because we're dividing it into the 132. So it's $12,543. So the loss of cash to the employee is $543, which is about $45 a month, which might equate to about $30 in loss of cash. So maybe a few coffees will impact their budget. Okay, Next slide, please. So the next thing I'm going to talk about is the work test requirement. So there's been a little bit of relaxation around this test that comes in from the 1st of July 2002. So currently, you need to satisfy the work test if you're aged between 67 and 74 if you want to make contributions that are either concessional or non-concessional. From 1 July 22, they're going to relax the non-concessional requirement for the work test. So you can put your money in, relax, you don't have to do any work. If you want to do a concessional contribution, that's the one where you get your tax deduction, which is $27,500. You need to satisfy that work test. What is the work test? Well, you have to work 40 hours over a 30-day period for at least once a year. Now, the test can be satisfied at any time during the year, but must be satisfied before the end of the year. So you can put your money in, say in December, knowing that you've got some work coming up in March, and you're going to satisfy that test. Now, if that falls over and you don't actually satisfy the work test, then you've got some issues to deal with. You might have to pull that money out, or you might have to apply it as a non-concessional if you're not breaching any of your caps. There's no change to the way that you actually lodge your notice of intention with your superannuation fund, but the ATO have said this is a target area. They will be doing reviews of the superannuation deductions that you claim in your personal tax return, and they've also issued what we call a woe-betide warning if you try and have any contrived arrangements to satisfy that work test. Okay. So, in summary, what's your action plan for the next 35 days? First thing you should be doing is making sure that your payroll system can cope with these changes that will kick in. It's going to be very onerous to have all those casual employees now in your superannuation having to get your employees to provide their choice of fund, get your superannuation fund set up, and make sure that you're also nominating their correct fund under their stapled superannuation fund, which you can access through the ATO. It was also a good time to make sure that you've got all your choice of funds documents lodged on your payroll system. And now is also a good time to review the MCB limits and make sure that you have the right limit going forward in your July pay run. Lastly, and most importantly, please review your employee contracts. Where you can, see if you can change some of those contracts from a gross salary plus super over to a TRP, because be mindful of the fact, as Janelle mentioned, that this superannuation is going to keep incrementing by 2% up until 1 July 2025. So you need to be mindful that that is going to impact your overall labour cost going forward. How can we help? Janelle and I are both very experienced outsourced payroll providers. We run multiple payrolls during a month for small, large employers, so we can deal with any payroll questions. If you happen to lodge late or can't pay your superannuation, you're subject to that awful superannuation guarantee, we can help you navigate that system with the ATO. We can prepare three-way budgets for you if you want some help with your budgeting and cash flow forecasts. And also, as a registered tax agent, we can also request those stapled superannuation fund details for all your employees. Okay, so we might go to our first question. So I've got an employee who works less than 30 hours a week, turns 18. Sorry, I can't read this very well. Might be a second. Okay. Turns 18, earns less than $450 in the same month. In the monthly payroll, I pay 10.5% super on his earnings for the entire month, or only on his earnings after he turns 18 in that month. So, Janelle, can I ask you to answer that question?
Sure. The SG only applies to earnings after the employee turns 18. So all earnings after this date will be subject to the SG.
Thank you, Janelle. Okay, we've got another question coming through. Where a pay period crosses over a financial year, say 19th of June to the 2nd of July, but the pay date is within the current financial year, 30 June, do I apply the 10% for the full pay or pro rata between 10% and the 10.5 for the applicable financial year? Janelle, do you want to answer that question as well?
Yeah, sure. It's actually on the payment date when it's actually where it actually falls. So if it falls into the next financial year after 1 July, you'll actually be subject to the 10.5%.
Great, thank you. Okay, we've got another question. So what if my employee becomes a contractor? Do I still have to pay superannuation at the 10.5% rate? So I can answer this question. So potentially yes. So under the Superannuation Guarantee rules, contractors can actually be deemed employees if they're individuals and the services that they're providing are more than 50% labour. So they'll actually be subject to super, and the 10.5% will apply on the GST exclusive amount of the payment. Okay, I think we've got time for one more question. Since I no longer need to meet the work test, what is the maximum non-concessional contribution I can contribute in 2023? Janelle, can I ask you to answer that one?
Yeah, sure. The amount will be $110,000, and you can use the bring forward rule up to the age of 74, subject to your $1.7 million cap from FY 21-22.
Great. Okay. So we might have a look at our poll results. So, in poll 1, we asked you how many employees you think will be affected by the relaxation of the casual employees, and we've got 45% have less than 20 casual employees. We've got 9% between 20 and 50 and 18% who have more than 50 employees. So yeah, they'll have a little bit of work to do on their payroll system. And our second poll was whether employees are on a TRP or on a Gross Plus Super package. 53% are on your Base Plus Super. So this will really be relevant for all of you to understand the financial impacts to the increase in the superannuation. And 40% are currently on a TRP. Look, in my experience, the clients that I work with, they tend to have a myriad of both because of, you generally find like some of the older contracts were Base Plus Super and some of the newer contracts of the employees coming through in the last couple of years are more TRP. So that's why we think it's really relevant to go through those and try and standardise them if you can. I only have to pay superannuation guarantee charge if I'm late in submitting my quarterly payments. Is that correct? Janelle, do you want to answer that one?
Sorry, you just cut out a little bit. I didn't hear the question.
Oh, I'm sorry. Okay. I only have to pay superannuation guarantee charge if I'm late in submitting my quarterly payments. Is that correct?
No, that's actually not correct. You also need to pay it if you underpay your employees.
That's right. Yeah. So there's two components to your superannuation guarantee charge. One is making sure if you're late, you've got to report it, and then you've got to pay it. So what's important is that you, with your superannuation contributions, you report that to your fund, and then you pay it within that 28-day time frame. And also be mindful of the fact that that 28 days, that clock ends 28 days after the end of the quarter, which means the funds have to be receipted in the employee's fund by the 28th day. So we always recommend paying your super, say, around before the 15th, because they have to go through clearing houses and sometimes that can take up to 10 days. So if you want to make sure that you don't get stung with your SG charge, pay your super earlier rather than later. Okay. I think that's it for our questions. I think that'll bring us to the end of our presentation today. So if you have any further questions, please reach out to your SW advisor, or Janelle and I would be happy to take any of your questions. Our contact details are on the last slide. As we mentioned before, we're also going to be sending the slides to you after this webinar. So I would like to thank everyone for joining us. Be well, stay healthy, and we'll see you soon. Thank you.